MRF, Honeywell Automation, Page Industries are the top 3 companies with the highest stock prices in the Indian listed market. But that doesn't necessarily mean a stock is expensive. Now, stock price versus stock value mean two different things. Stock price is what it costs you to buy a share, while the term expensive talks about its valuation. Now, different sectors use various metrics, and here are the 3 typically used ones. First is the price to earnings ratio, which is the most common one used, and it compares a company's stock price to its earnings per share. It basically reflects how much an investor is willing to pay for each unit of profit. A high PE means that the stock may be overvalued, while a low PE could imply the opposite. Second is the price to book ratio, which is typically used for valuing lenders and banks, and it compares the stock price to the book value per share. Now, book value represents everything belonging to the equity shareholders in the balance sheet. This includes your equity capital as well as reserves. Now, this ratio indicates the valuation given by the market over the capital that is invested by the shareholders in the business over the years. A higher PB means that the stock is more expensive, while a lower PB means it's cheaper. And lastly is the EV, which is enterprise value to EBITDA ratio, which is typically used by cement companies, pharma companies, as well as commodity-based companies. Now, it considers a company's total value, which includes your debt as well as market capitalization. It basically tells you how much you would pay for every unit of cash flow that the company generates. A low ratio suggests that you're paying less, while a higher ratio indicates the opposite. However, when looking at any of these 3 ratios, it is important to keep in mind to compare it to their historical averages, as well as their industry peers and future growth prospects.